A partner at a multi-billion-dollar fund keeps 20% of profits, but pays capital gains rates instead of income tax. It's perfectly legal, and it costs the government billions annually. Carried interest is compensation. When a private equity manager deploys other people's capital and generates returns, they pocket a percentage, typically 20% of those profits. That payment is called carry. The mechanism itself isn't exotic. What is remarkable is the tax treatment. For decades, these earnings have been taxed as long-term capital gains, not as ordinary income. The difference? Capital gains rates sit around 20%. Ordinary income rates climb to 37%. On a billion-dollar fund posting 30% returns, that disparity translates into tens of millions in reduced tax liability per year. The argument for this treatment hinges on a 1950s interpretation of Tax Code Section 1231. The IRS determined that if a fund manager's carry was genuinely a profits interest, not a salary guarantee, it could qualify as capital gain treatment. The logic: the manager bore real risk. They had skin in the game. If the fund lost money, so did they. In theory, sound. In practice, it became a loophole. By the 1980s and 1990, private equity exploded. Leveraged buyouts multiplied. Fund sizes swelled into the billions. And with them, the tax savings grew stratospheric. A partner earning $100 million in carry paid roughly $20 million in taxes. A salaried executive earning the same paid $37 million. That gap became impossible to ignore. Congressional scrutiny intensified. Multiple reform attempts were drafted. In 2010, the Obama administration proposed the Carried Interest Fairness Act. It would have reclassified carry as ordinary income. The private equity lobby mobilized. They argued that higher taxes would reduce capital available for acquisitions, job creation, and growth. The bill stalled. It never passed. Similar proposals surfaced in 2014, 2016, 2019, and 2021. Each time, legislative momentum faded before enactment. Why political leverage? Private equity firms donate substantially to both parties. They employ thousands. They fund pension systems for teachers and firefighters. Opposing carried interest reform meant opposing a sector woven into institutional finance and retirement security. The math was clear. The cost of change exceeded the political will to enact it. Today, carried interest taxation remains largely unchanged. Some states have introduced modest reforms. New York attempted a surcharge, but federal policy has held steady. A partner earning $500 million still benefits from capital gains treatment on the vast majority of that income. The structural advantage persists, embedded in tax code interpretation, defended by institutional inertia. Understanding carried interest illuminates how tax rules aren't written in stone. They are interpreted, lobbied, defended, and occasionally reformed, but only when political pressure outweighs institutional resistance. This particular mechanism reveals how compensation structures and tax classification intersect, and why that intersection matters to the ultra-wealthy. The system works as designed, just not necessarily as the average taxpayer might expect. For more on how the wealthy navigate financial architecture, subscribe. There's a new mechanism unraveled every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover the next financial mechanism, the powerful use to shape the rules. There's a new one every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.